Hey, how's it going, guys? In this video today, I'll be talking about my love for the cash secured put. As I see it, the cash secured put is a very simple, effective, yet versatile way to grow your account. It's very simple to understand for those who are newer to being short options. As well, I think it's a very good way to grow your account at a risk-adjusted basis and has a better risk-adjusted return when compared to the buy and hold for index funds when measured over a longer period of time. In this video today, I'll be primarily focusing on the benefits of the cash secured put as well as my guide to trading cash secured puts in terms of how to select the strike price, the expiration date, as well as the underlying security. I'll very briefly first go over the cash secured put and what it is, but I'll primarily be talking about my guide and the benefits of the CSP. Let's get right into it. If you're watching this video, I'm assuming that you have a pretty solid understanding of the put already, but simply put, it's going to serve as your insurance contract. So in real life, if you have an automobile, chances are you have car insurance. This is to hedge against the probability of being in an auto accident where property is damaged or an injury occurs. Similarly, in real life, investors who are long stock may be apprehensive about an event such as earnings, and they choose to purchase put options to hedge against their long position. Of course, however, you can buy puts without owning the underlying security if you're speculating that the price is just going to go down. This would be the equivalent of buying car insurance on your neighbor's car because you saw him back into his mailbox once and you believe that just about any day now he's going to cause a serious auto accident. So it doesn't really happen in real life, but in finance, it's the wild, wild west. So as the cash secured put seller, you are pretty much acting as the insurance company. You believe that the stock that you're selling puts on will not depreciate or might even appreciate, and you are perfectly fine buying 100 shares at the strike price if you are assigned, assuming that the stock is below the strike price at expiry. The cash secured part of the cash secured put simply means that you have enough money set aside that you don't really need to hedge the position. This is in comparison to, say, a debit spread where you're going to have another option to pretty much hedge your losses. In this example, you have enough money set aside to pretty much undertake the maximum risk of buying 100 shares. You have that money set aside in your account. And so you don't really have any long leg. It's just a very simple short option strategy that has a simple short leg. So it's quite easy to understand. And in this example here, you can see that if you believe the current stock price, let's say it's a bit above $100, you believe that when this option expires, it's not going to go below $100. This is going to be your payoff. The maximum profit you're going to achieve is going to be the premium you collect if it closes at or above the strike price. So pretty much if it's $100, $105, $110, you're going to be making the same premium. Obviously, if it goes below the strike price, you're going to be assigned 100 shares. So your maximum loss is going to be about $9,700 because of $3 you collect in premium. You're going to be assigned shares at a $97 average pretty much, and from there you have 100 shares. Again, the CSP part of it is just you having $9,700 in your account so that you may buy the shares if you are assigned. So why do I believe that cash secured puts are so versatile? I actually wrote a blog post about this, why selling put options is great. The three main reasons I believe that cash secured puts are awesome is that, first of all, time decay. By being short the option, you are collecting this time premium for every day that passes that the stock either doesn't move or moves in your direction. And this appeals to a very wide audience who really like the idea of, say, making money overnight or by doing nothing, just by patiently waiting. Certainly that's one of the reasons it really appeals to me. So there's a gentleman named James Cordier.
Good afternoon. This is James Cordier of optionsellers.com.
He's fallen on hard times in more recent years, but he was a natural gas trader, and he pretty much made this analogy about selling options. He made the analogy that it's like a sports game. So pretty much you're in the last quarter, and you get to decide how many points your team is going to be up, or maybe you want to make the teams even. You get to decide how many minutes are left in the game, and you're pretty much betting that your team's going to win. So based on how much time you give left in the game and how much of advantage you give your team, the payout's going to be different. Obviously, if you put the teams very close to each other with a bunch of time left, that's like selling an at-the-money put option that has a month or two to expiration. You're going to be collecting a decent premium. Meanwhile, if you have 2 days till expiration and you have a huge lead and the option's way out the money, chances are the option's going to be pretty close to worthless by that time already. So again, you decide how much of an edge you have, and you decide the risk tolerance you're going to take, the strike price, the expiration, and etc. The second reason I really like it is that it's really easy to reposition. Especially contrast this with buying a put option when you're not doing it to hedge a long position. One of two things is going to happen again. It's going to expire in the money or it's going to expire out the money. The tail end is that you make a tremendous amount of money buying puts and that the stock crashes. Obviously, that's the main appeal. But a much larger probability is that it will expire in the money, but it's not enough to make up for the premium, so you still lose money. Or it expires worthless in that you pretty much lose your entire account. And that's how most people on Wall Street bets end up blowing $100,000 in these screenshots. When you're selling the put, on the other hand, it's quite the opposite. There is no worst case scenario. Again, going back to this diagram about these cash secured puts, one of two things is going to happen. One, you're going to keep the whole $3 if you don't get assigned and you get your money back. The option expires worthless. You're free to use all your cash to sell another put. Or the worst case scenario, or I guess the other scenario in this case, is that assuming you did your research, you like the stock at $100, you're certainly not going to be concerned having a $97 price average. And even then, you're still free to hold the stock. It could very easily appreciate way beyond $100 in the future, or you can even collect additional premium by selling a covered call against it. So plenty of options if you do get assigned. If anything, I think the worst case scenario is the stock doubles from 100 to 200, and you could have made a lot more money buying the stock in that case. But again, by the time you actually sold the put, one of two things are going to happen. Neither of them are really going to be bad news if you like the stock. And finally, the last point really appeals to me, and I think it appeals to quite a few others as well, in that there's a very defined time range for when you're selling the option. Compare this to being long a security. It might be a kangaroo market, and it might be the same price for a year or 2 years. It's quite easy to get impatient, I believe, if you're actively looking at your portfolio, and you might be impatient that the stock's not moving, and you might be always debating whether or not it's the right time to sell. When you're selling a cash secured put, on the other hand, or any option strategy, you define a time range in that if you sell a monthly option that expires, let's say in 4 weeks, you know that day is going to come. You know that there's going to be a stock price that day. The only thing that's an unknown is what the stock price is and whether or not it's going to be in the money or out the money. And that's pretty much what you're betting on. But the fact is, you know that that day is going to come. So you're pretty much just playing a waiting game, but exactly how long you're waiting, that's something you already know. So me personally, it's a lot easier for me to sit back, relax, sell a cash secured put. This allows me to look at the portfolio a lot less. Back in college, I was day trading quite frequently. It's not something you can do as frequently when you're not working from home. So I try to stay a bit further away from the markets these days, and I certainly do believe that selling cash secured puts is one way that lets me be at ease instead of having to constantly monitor my accounts. So I'd say it's very helpful for mental health. So let's get into the actual guide itself. There's pretty much 3 things that you are going to decide on when you're selling an option. Those attributes are going to be the expiration date, the strike price, as well as the underlying instrument. Of these 3, your strike price is probably going to be the most subjective. That's going to be entirely based off of what you feel the strike price is going to be at the time of expiration. Take a look at CrowdStrike for a moment. It's very similar to the example we see over here with the cash secured put. It's pretty close to $100. If we take a look at the option chain actually for February 17, you will see that the premium again for the $100 put is going to be around $3.35. So very similar to this payoff matrix over here. But do you want to sell a $100 put? Well, it's been at $92 just a couple of weeks ago. So you might believe that we can double bottom, in which case you might want to be a little bit more conservative, collect less premium, and sell a 92 put. On the other hand, if you believe that we're due for a huge market rally, you might sell an at-the-money put, you might sell something that's close to $100, or you might just decide to buy the stock outright or sell an in-the-money put, which would give you a delta exposure of above 0.5, so that's if you're really bullish. So the strike price is going to be the most nuanced. One thing that's a bit less nuanced is going to be the actual expiration date. There's been a lot of research and debate about what the optimal time to expiration is for opening a short position on a put option. I believe Tastyworks mentioned that their research dictated that around 30 to 45 days was optimal for maxing out the data collection for an at-the-money option. And you can see here from this graph that's really where the elbow starts to occur in this data burn curve. Personally, for me, I am a little bit less patient, so I don't really want to go out 45 days. Typically, I select something closer to 20 to 30 days. So if you're selling weeklies all the time, I think that has been said to have better absolute return, but that assumes that, again, you're correcting your forecasts and that the stock price can probably still stay afloat or go back above your strike price if you are assigned. This obviously doesn't work for a continually depreciating asset like a leveraged volatility ETF. And so there's not really a right answer to the optimum amount of days you want to decide, but I think there is a wrong answer, and that is think about it in the perspective of a buyer. The highest risk and how to really blow up your account is to buy a 0-day to expiry option or anything that's pretty much short term and at the money or out the money, but pretty much less than a month to expiration. That's where you see a lot of the risk really come into play. What's less risky for the buyer is if they buy a leap, such as if it has 2 or over 2 years of time until it expires. Again, you can see from this curve that the data burn really occurs in the last month or month and a half in the lifespan of the option. If you have an option that expires in 2 years, every day that passes is going to be like 1/700th of the time value assigned to that option. You're not really going to be burning any data by being short that option. So I'd say personally, I would never go more than 60 days. Of course, there are nuances. There are preferences. If you want to sell a leap on a security that you are anticipating to hold for the next 2 years and you want to sell something that's really out the money, I think that's a fair strategy, but just not one that I would personally use. For me personally, 20 to about 30 days is the sweet spot for me. And finally, the last part and the hardest part is to select the underlying instrument. It's the hardest part because imagine yourself as an insurance company. You can have a client that comes in and let's say they're paying you 10 times the premium of your regular customer. However, they have a terrible driving record. Pretty much it doesn't matter how much premium you collect from them. If they crash the car and you have to do a payout, you're going to be down a lot of money regardless of how much premium you get. And this is true for the vast majority of cases. When I first started selling options, it was very tempting for me to go on one of these implied volatility screeners, sort implied volatility from highest to lowest, and then look at some of these stocks and say, oh, wow, look at this. Over time, I learned that this was actually a pretty bad strategy. I learned that the higher the implied volatility, chances are that it actually underestimates the true realized volatility at the time of expiration. What I mean by this is that you can see a lot of these are biotech companies or SPACs that really haven't performed so well. A lot of these values just aren't accurate when you have a stock that's 7 cents, for instance. But if you take a look at Riata, for instance, that has a $40 price, this implied volatility is accurate. Reason being that they're a biotech company with a readout, I believe, in the coming months. And so that's really going to factor in. I lost a tremendous amount of money selling puts on biotech stocks that had a binary event that was just a data reading. So when a stock falls, it falls a lot. So I lose a bit of money on that. Problem is that the stock falls and it stays low and chances are it decays into zero. So you really want to have the long-term viability of the stock in mind. Again, the worst case scenario is having 100 shares. So you better hope that the 100 shares are something you wouldn't mind holding. What I found really works for me is somewhere around the 50 to 70 range. In the 70 range, you're going to have a lot of these tech companies that chances are they have a balance sheet, they have revenues, growing revenues, but they don't have any free cash flow. So these companies might be looking to raise capital at some point in the next year or 2 years or what have you. But take a look at some of these names here. Again, we see Asana. I think I saw Overstock.com right there. These names are going to be around in 2 years, but they are going to be quite volatile. So trade at your own risk tolerance. And finally, if we go towards the 50 range, this is where we get into some of the safer names. You're going to have names such as, I see here, PayPal, NVIDIA. I think Facebook was on here as well, a bit higher. You got Snowflake. I don't think they have positive cash flow, but they're certainly very big. So these companies are going to be less volatile. And again, you're going to have companies that are, again, much larger in size at this point. It's going to be very conceivable they're going to be around, and I think it's much more likely they're going to have a decent balance sheet without having to sacrifice too much in terms of dilution to existing shareholders. But again, this is the lowest implied volatility I would pretty much go for. And finally, if you really want to play it safe, you can go all the way back towards blue chip stocks. Think about names like IBM, McDonald's, Chevron, Coca-Cola. They're probably going to have an implied volatility around this range of the mid to low 30s or even the high 20s. You're just not going to really collect much premium, if any, by trading these. Again, you're going to see some oil companies, some gold miners, large established companies. For me, it's just not worth it at this point to actually sell puts against it. I do prefer trading slightly out the money puts. I feel as though from my experience as someone who likes to catch knives, I never really do call it a bottom, so that gives me a bit of buffer. As a result of that, I wouldn't really sell an out-the-money put option on one of these stocks because the premium's just not going to be very significant at all. But if this is something you're interested in, or you're interested in selling at-the-money puts, it's certainly an option for you guys if that's, again, what you're interested in. So with all that being said, thank you so much for watching this video. I hope you enjoyed my guide to selling cash secured puts. Again, I think they're very versatile, and I hope that if you choose to explore the strategy, or if you're already trading cash secured puts, that you may be able to compound your account. Hope you guys have a good one. Take care.